Loans. Retail loans. The needs of a common man are gradually increasing. The things considered as luxury some time ago are now becoming necessity. As income and means are limited, fulfillment of all the needs sometime appears beyond reach. So always there is a need for some extra money to fulfill those ever-growing needs. Where does the extra money come from? The banks, of course. The banks do lend money to fulfill some such needs. The needs of a common man are gradually increasing. The things considered as luxury some time ago are now becoming necessity. As income and means are limited, fulfillment of all the needs sometime appears beyond reach. So always there is a need for some extra money to fulfill those ever-growing needs. Where does the extra money come from? The banks, of course. The banks do lend money to fulfill some such needs. The needs of a common man are gradually increasing. The things considered as luxury some time ago are now becoming necessity. As income and means are limited, fulfillment of all the needs sometime appears beyond reach. So always there is a need for some extra money to fulfill those ever-growing needs. Where does the extra money come from? The banks, of course. The banks do lend money to fulfill some such needs. By the end of this lesson, you should be able to define the term retail loan, list the common types of retail loans provided by the banks in India, and explain the features of each type of retail loan. First, let us see the key terminologies related to the retail loans. Equated monthly installment or EMI, fixed and floating rates of interest, flat rate of interest, and front-ended interest. Equated monthly installment or EMI. The EMI is a loan repayment method wherein principal and interest is repaid through monthly installments over a fixed tenure of the loan. The formula to calculate the EMI is EMI is equal to P into R into 1 plus R whole raised to the power n divided by 1 plus R raised to the power n minus 1. In this formula, P is the principal loan amount or amount actually taken as loan, R is the rate of interest which needs to be divided by 100 to bring it into the decimal fraction form, and n is the number of installments. Let us look at an example. Mr. Brijesh Patel has taken a loan of 10,000 rupees from a bank at the rate of 10% interest per annum, which is to be repaid in 12 installments. Now, let us calculate the EMI payable by Brijesh Patel. Principal loan amount P is equal to 10,000 rupees. Rate of interest R is 10%, that is 10 divided by 100, which is equal to 0.1. Number of installments N is equal to 12. Using the EMI formula, the monthly EMI comes to 1,468 rupees. Fixed rate of interest. The fixed rate of interest is a type of interest wherein once rate is fixed, it will remain same throughout the loan duration. Floating rate of interest. In this, the rate of interest changes based on the market conditions. The frequency of the change in the rate will be as per the reset clause in the loan agreement. Say, initially interest rate on a loan is fixed to 10% and loan is to be repaid in 24 months. Suppose, after 6 months, the inflation rate becomes 2%. So, the rate of interest will be revised to 2 plus 10%, that is 12%. If 6 months later, inflation rate changes again to 6%, this revises the rate of interest to 6 plus 10, that is to 16%. At the end of 18 months, say, inflation rate falls down to 1%. The rate of interest accordingly changes to 1 plus 10, that is 11%. And at the end of 24 months period of loan, if inflation rate is increased to 4%, then the interest rate will be 14%. This is one way. The interest rates get revised as per the market conditions and inflation rate. Reducing balance method. In the case of reducing balance method, the principal gets reduced at the end of every month and the interest is calculated on the outstanding principal at the end of the month. Flat rate of interest. In the case of flat rate, banks calculate interest on the original amount lent, though borrower repays the loan in installments. For example, say Mr. Brijesh Patel takes a loan of 10,000 rupees from the bank at 10% flat rate of interest payable in 5 EMIs. Let us see how much interest he needs to pay to the bank. The loan amount is 10,000, payable in 5 EMIs, and the flat rate interest is 10%. Hence, the total amount paid is 11,000 and interest paid is 1,000 rupees. Front-ended interest. In this case, interest on the loan amount is deducted upfront and the balance net amount is paid to the borrower. For example, say Mr. Brijesh Patel takes a loan of 10,000 rupees from the bank at 10% front-ended interest, which is 1,000 rupees. So, the bank upfront deducts the interest from the principal and pays 9,000 rupees. Here, Brijesh Patel gets only 9,000 rupees and pays interest of 1,000 rupees. This essentially means that he actually paid interest on the net amount of 9,000 rupees, which actually equals to 11.11% and not the 10%. This method of interest calculation is also called discount rate. Overview of retail banking. The retail banking refers to the business transactions by the banks with individual customers. The key transactions include deposits and loans. The retail banking also includes services like providing credit cards, remittance services, and selling of mutual funds and insurance products. The key characteristics of the retail banking are multiple products, multiple channels of distribution, and multiple customer groups. Present scenario of retail loans. The retail lending is one of the key functions of the banks falling under retail banking sector. Let us now see the retail loans and the features in detail. In the last 5 years, the retail lending business has grown sharply. The reasons attributed for this growth are population growth, demographic factors, growth in consumerism, and easy availability of credit cards and retail loans. Types of retail loan products. Some typical products fall under the Indian retail lending segments, which are home loan, loans for consumer durables, vehicle loans, credit cards, educational loans, personal loans, loans or advances against shares. Home loans. The home loans are sanctioned by the banks and the housing finance corporations to the salaried professionals and the self-employed professional for buying a plot, constructing a house, buying a residential flat, and renovating an existing house. The scope and growth in the home loans is enormous and it accounts for about half of the total retail loans. The home loan is given to meet cost of land, construction or cost of flat, and interior decoration. In this, the cost of renovation and extension is also covered. For the home loan, borrowers can be single, joint, or of corporate type. Based on the borrower's cash flow, age, income, and remaining period of employment, the period of home loan can be of medium term, that is for 3 to 5 years, long term, that is for 6 to 14 years, and very long term, that is for 15 to 20 years. Generally, the home loans come with either the fixed rate of interest or the floating rate of interest.